Hello, everyone. This is Phil Yeager, and welcome to my Facebook video live today. It is Saturday, January 6th, and I'm here in Maryland, and it is so cold. I don't know where you are in what part of the country, but this is like being in the Antarctic. In fact, we are now called the mini Antarctic. I expect glaciers to be forming any day, and it's presently about 15 degrees outside. So it is cold, and if you're in one of these areas, all right, stay warm, stay warm. See, I'm wearing this sort of heavy type sweatshirt, if you want to call it that, to stay warm. However, all right, whether it's cold or warm, the CPA exam studying goes on. Now, what are we going to discuss today? We're going to discuss a few areas. Non-liquidating distributions from C&S Corps, and then we'll talk about Section 351. Now, these are two areas that are covered in the blueprints, all right, that the AICPA tells you what tasks you have to know. Now, let's talk about the difference on a non-liquidating distribution, all right, from a C and an S corporation. Well, let's start with a C Corp. C Corp files a Form 1120 and basically is going to pay taxes if they have taxable income. And what happens is when a C Corp decides to give a non-liquidating distribution, they're basically paying out some form of dividend, whether it's property or cash or both. Now, let's talk about the tax consequences of a C Corp when they distribute appreciated property as a dividend. Well, the corporation, the C Corp, will have a gain only if they distribute appreciated property. And appreciated property is where the fair market value of the property they're distributing exceeds its basis. Now, if the fair market value exceeds its basis, the C Corp will have a gain. Now, the gain is determined, the character of the gain, by what type of property they're distributing. So if they distribute a capital asset, that is a capital gain. But if they distribute a non-capital asset, and that will be an ordinary gain. And please keep in mind, if they distribute property as a dividend and the property has gone down in value, which means that the fair market value will be less than the basis of the property, the corporation, the C Corp, cannot recognize any loss. All right, just remember that. Now, what happens if they distribute also cash? Well, cash, the fair market value and the basis are the same. The corporations have no gain or loss when they distribute cash. Now, let's go over to the stockholder. All right, the stockholder always picks up the fair market value of the property plus any cash they receive. That's the distribution, the fair market value of the property plus the cash they receive. And the way it is taxed to the shareholder is a three-step process for a C corporation. The first step is the amount of the distribution is dividend income to the shareholder to the extent of the corporation's current, if positive, and then accumulated earnings and profits, if positive. The current earnings and profits and the accumulated earnings and profits are really the accumulated retained earnings of the corporation, and we call that current and accumulated from a tax standpoint. Now, they will never ask you how to calculate current and accumulated earnings and profits, but what they will ask you is, how are they used? Well, all right, if you get a distribution of fair market value property, all right, plus any cash, step one says that portion of the positive current earnings and profits of the Corp and the positive accumulated earnings and profits of the Corp are considered dividend income, all right, as far as that distribution goes. So if we have a distribution, say, fair market value of the property is $300,000, I'm just jotting some notes here. Fair market value is $300,000, and the current and accumulated earnings and profits that are positive are $50,000, all right? We still have another $250,000 of distribution to account for. Well, how do you then treat that other $250,000? Second step is, whatever the shareholder's basis is in that C Corp, all right, that is non-taxable because the next portion of distribution is a return of your shareholder's basis, which is non-taxable. All right. So if you have a basis of 75,000, all right, and remember the remaining distribution was 250, and the shareholders' base is 75, and 75 of that 250 is non-taxable to the shareholder, and that leaves a distribution not accounted for of 175. Now that 175, step 3, will be a capital gain. Now, what happens if you're an S corporation instead of a C corp? Well, first of all, if S corporations, all right, distribute property, all right, it is not a dividend. All right, remember that. S corporations, all right, do not distribute property as dividends. There's generally no dividends for the shareholders of an S corporation. So, if an S corporation distributes property, it's not a dividend. However, all right, similar to C corps, if the fair market value of the property that the S corp distributes exceeds its basis, the S corp will have a gain, just like a C corp. Now, what happens to that distribution, all right, as far as the taxability to the shareholder in an S corporation? Well, step 1 is now different from a C corp. Step 1 says the portion of the distribution is first a distribution out of the accumulated adjustment account. Now, what is the accumulated adjustment account of an S corp? That is all of the ordinary income, all right, because an S corp is like a partnership, and they have ordinary income which flows through to the shareholder, and that shareholder is taxed on that ordinary income. And that ordinary income represents undistributed income of the S corp. So we want to keep track of how much ordinary income has been distributed and taxed. All right, let me repeat that. We want to keep track of the ordinary income that is taxed to the shareholders of an S corp but not distributed. All right, and that amount goes into the accumulated adjustment account. So whatever the balance is in that accumulated adjustment account, the first portion or the first step of the distribution to S corporation shareholders is non-taxable, because why? Well, first of all, S corporation shareholders do not get dividends normally, and also, all right, that accumulated adjustment account, which is the amounts of the ordinary income which have been taxed to the shareholders, will not be taxed again. So the distribution of the accumulated adjustment account is a non-taxable portion of the distribution to the shareholders. All right, now step 2, all right, same as a C corp. The next portion of distribution is a what? A return of stock basis, which is non-taxable. And then third, if you still have an amount of distribution like a C corp, but for an S corp, that's a capital gain to the S corp. Now, let's take one exception. All right, will there ever be any dividend paid to an S corporation shareholder? And the answer is yes. If the S corp was previously a C corp, and that C corp had some earnings and profits which were never distributed to the shareholders, all right, then what is the distribution to the S corporation shareholders, and how is it taxed? Well, the distribution is the fair market value of the property plus any cash that's distributed. All right, that's the total. And then we said step 1 is a distribution of whatever in the accumulated adjustment account of the S corp, which is non-taxable. Now, the second step, if there was earnings and profits because they were a C corp prior to being an S corp, that portion of that earnings and profits, right, carried over to the S corp is dividends to the S corporation shareholders. All right, and then third step would be a return of stock basis, and then fourth step would be capital gains. All right, so keep that in mind. That's the difference between C corps and S corps. All right, now, I told you I was going to cover section 351. All right, now, they'll say to you, what is section 351? Well, that's the rule, whether it's a C corp or an S corp, both can have a section 351 transfer. All right, and that section 351 is this. If you are a C or an S corp and you're a shareholder and you transfer property to the corporation upon the formation, and the shareholders, either 1, 2, whatever, acquire 80% or more of the stocks, which is control, there's generally no tax consequences to either the corporation or to the shareholders. However, there will be, and I repeat, there will be gain to the shareholder in a Section 351, even though they get 80% or control, if the shareholder receives cash or marketable equity securities in another corporation. All right, those are considered boot received, and they are taxable boot received to the shareholder. So those are two situations where even though the shareholder gets control, whether it's a C Corp or an S Corp, if the shareholder also receives cash, all right, and also marketable equity securities in another corporation, the total of those two amounts, or they could get one or the other or both, all right, is considered a taxable event to the shareholder. All right, keep that in mind. Now, know what Section 351 is. It's a little more involved than what I just went, but you also have to know what is your basis in the stock of this new corporation. All right, also, what's the basis of the property now when you transfer it in to either the C or the S corporation? These are things you have to know. All right, now, these are stated in the blueprints. All right, these are basically two captions that are required tasks in the AICPA blueprints. And once again, I recommend that when you're studying, all right, you go over the blueprints. All right, now, you don't have to worry about the Jaeger course because Jaeger does go over and start their books. Their books are all written, all right, with every blueprint and a tremendous discussion under each blueprint of what that area is all about. All right, so if you know the blueprints for our course, all right, you can do them for all the blueprints, and the blueprints are the only things they're going to test on the exam as far as the areas. All right, so please remember, these blueprints are so important. I can't overemphasize them. Now, also, all right, when people call me up and they tell me they got a score of 73, 74, 72, all right, I generally say to them, look at your diagnostic report. And I bet you were weaker in entities, all right, which is your partnership and corporation tax. And 90-some-odd% of the time, that is the area they were weaker in, and that's why they didn't pass. All right, so what you have to do is this. You have to know your corporation and partnership taxes, all right, and you have to know it cold. And you have to know what areas they test by looking at the what? The blueprints. All right, secondly, all right, a lot of times that is one of the reasons that causes you to have a lower score, not passing, your lack of knowledge in entities. Also, all right, another thing, the second most item that causes a grade of less than 75 is your knowledge of property transactions, all right, which deals with a lot of basis issues and also like-kind transactions. And the third one, all right, and by the way, if you are weaker in this area, I can tell you the chances are you will not pass because it is professional responsibilities. And the profession expects you to know what ethics you are subject to. All right, what's your responsibilities as a professional CPA and a tax practitioner? And God, if you don't do well on that, all right, hey, that's the profession. You're an unethical person if you don't know the rules. I'm not saying you are, all right, but I think maybe the AICPA thinks that way, and maybe they don't pass you. So those are the three main areas of the regulation: the entities, the property transactions, and the professional responsibilities. Now, I'm not saying you don't have to know the business law, all right? You should know business law, but that's not one of the areas that cause the problem. And why does entities cause a problem? Because most people only have one course in federal taxation, which covers mostly individuals. They might touch upon partnership and corporation tax, but very lightly, all right? Ideally, it would be nice to have two courses in federal taxation, all right? But there's not enough time in these programs to do that. So therefore, we will teach you the entities if you didn't learn it well in your college course. Keep that in mind. Well, let me make one other announcement here. First of all right, we do now sell our books. if you want to buy our books, they are available for sale. All right, check our website, YagerCPAReview.com. And then one other thing I would recommend is if you did not pass by, say, 5 to 10 points,